Hi, welcome to today's video and thanks for joining me. Today we're going to be talking about a year-end checklist. Now this checklist is something that you ought to be doing every single year, November, December, depending on when you do your planning. So it's designed to finish the year strong for you and get you ready to hit the ground running for the next year. Let's get into it. The first one we're going to talk about is your retirement savings. You want to make sure that, first of all, your account is fully funded. You know, you have made your contributions through the year. Maybe it's month by month or one time back in February and you were done for the year. Many of you work for an employer where you have group retirement accounts where you're contributing and your employer is matching that contribution. So you just want to review where you are at in terms of your annual contribution. Of course, you know, you start off by doing a financial plan. I say this in every video. It's seeing the outcome of your planning decisions before you commit to them. So a great way to know if you're saving enough is to get a financial plan or retirement plan done. It's the same thing, really. And it'll tell you how much you should be saving each and every year in which accounts, RSPs, TFSAs. It'll actually outline, very detailed. I hear people saying it all the time. This is so detailed. So your plan will tell you how much you should be saving. So you've got another month to go, and that'll help you to figure out what more or how much more you ought to be contributing. So let's talk about your withdrawal strategy. Nobody talks about this. Your advisor probably is talking about make the contributions, get this kind of rate of return, but nobody talks about on the end, how much money should you be taking out of which accounts, what's the actual schedule. Is it RSP first? Is it TFSA first? Is it non-registered? Do you have corporate assets? Nobody's talking about your withdrawal strategy. So let's dig into that real quick. The first thing that you're going to consider in November right now is how much money, if you plan on making a TFSA contribution or a withdrawal, how much money are you going to be taking out? So you're really examining this idea of, hey, we're pretty sure we're going to make a withdrawal in 2024, then you ought to be making that withdrawal in November. Why? Well, because your TFSA has a limit as to how much you can contribute each year. Now, there is unused contribution room, but let's say you had filled up all that unused contribution room, then all you really have is the annual contribution amount. In 2024, that, by the way, here's some good news. They've increased it to $7,000. So your only contribution room you have is $7,000. Now, if you do a withdrawal in 2004 out of your tax-free savings account, you can't put that money back in if you've used up all your unused contribution room. So if you take the money out now prior to the end of this year, that means in 2024 you could add that money back into your, so you could repatriate that money back into your TFSA account, so you get to pull the money out and put it back in a relatively short period of time. So you always want to review what you plan to do with your TFSA in the following year and see about doing that withdrawal ahead of time. Let's talk about RSP withdrawals. Now, if you're either in one of these two situations, you are near retirement or you're in retirement, and you might be doing an RSP meltdown already, so you want to make sure what is the schedule for the next year and just go through that, review it. But if you're in that phase where December is your last employment month, congratulations, and January comes and now you're fully unemployed, good, you're fully retired, but where is the income coming from? So that's where you might be doing an RSP meltdown. Certainly it's an opportunity for you to begin an RSP meltdown, especially if you're young and you don't have CPP and old age security, you don't have a pension plan coming in, you need access to some kind of income stream. So this might be a good opportunity. Also, the RSP meltdown is you don't want to leave too much money behind at your passing, so you're trying to melt down that strategy or melt down that income. You can see just as this example here, that yellow shaded area, this is someone who's 60 years of age, they're not working anymore, and they're going to withdraw, as an example, they're going to withdraw $35,000 out of their RSP for a period of 6 years, and then they don't do anything. And then they begin their normal withdrawal schedule in either their RRIF account at this point. So you can see that's an example of an RSP withdrawal. We're just trying to melt down that RSP. So what I'm asking you to do is have a conversation with your advisor about what is the schedule for you to do RSP meltdown, and to make sure that they're ready in January for you to receive that money. If you're waiting till January and they're on vacation, maybe you're on vacation and you find you don't have a paycheck coming in, right? So have that conversation now so that they're prepared to do everything that they need to do to make sure you get that money being deposited to your checking account. If you are purchasing a home in 2024, what I would suggest that you do is delay the withdrawal of your home buyer's plan. Now, I know you're thinking about how you want to get that money ready for you to do the first-time home buyer. And so what you really want to do is you want to make sure that you just delay it. Now, a little refresher, the first-time home buyer's plan allows you to take $35,000 from your RSP and transfer it into your first home. And now, you have to repay this money. After 1 year, you have to begin this repayment plan annually, putting this money back into your RSP. It's not another deduction, you already did that, but it's just a repayment. You're basically loaning yourself the money and you have to pay it back. If you don't, you got to pay some tax on that money. But the idea is if you did the withdrawal in 2023, in the last part of 2023, by delaying it to 2024 and take your withdrawal there, well, then it gives you an extra year to not have to make that first payment to your loan. So it's just giving you some breather space, that's all. Well, this is a good lead into the RRIF. If you are turning 71 this year, you have a month left in order to convert your RSP to a RRIF. December 31st is your last day, so you've got to be able to convert your RSPs to a RRIF. So keep that in mind. If you are 71 already this year, you got to switch those RSPs over to a RRIF. And you can either put it in an annuity or in a RRIF account. Now, here's an opportunity for you to have a little mini RRIF. Now, what is a little mini RRIF? This is taking advantage of the pension tax credit. I don't really talk about this on my account, on my YouTube account, because it's a small tax credit. Doesn't really apply to many of the clients that I work with because of their income is so high. But in any case, it is some money coming back to you from a tax credit, so let's review how that works. If you're between the ages of 65 and 71, what you want to do, this is a non-refundable tax credit up to $2,000 of eligible pension income. And what you want to do is you want to take $12,000 and transfer it from your RSP to your RRIF. So you're not RRIFing your entire RSP account. You're just going to RRIF $12,000, and then what you're going to do for the next 6 years is going to withdraw $2,000 from that RRIF account each year for 6 years. That's going to equate to roughly $400 of tax credits each year, because it's 15% right on the $2,000, plus you get a little bit from the province as well. If you are a low-income earner, then you're going to get the first $2,000 absolutely free, so no tax. So there's obvious reasons why you would want to use this tax credit. Insurance, not going to go into insurance today and talk about which insurance to purchase and so on and what does it mean. It's just really quick. Every year you want to review, is the insurance that you have relevant to you today? So while you might have specific insurance policies to address tax problems, so you have a tax problem on your estate, or you're trying to get money out of your corporation and deposit it into insurance, I talk a lot about that. You can see these videos all about how to use life insurance, because it's one of the most, it's like the Cadillac of, I think, of tax deferred growth of investments. But anyway, what you want to do is you want to look at your term policies. Now, you might have taken out, do you remember taking out these big mortgages when you were younger and you put term insurance in place? But now that you're approaching retirement, all those debts are gone. So the question is, do you still need those term policies? And as you're getting older, what you don't want to have happen is you forgot about the renewal. And this time comes up where the policy renews on you, and it's going to renew at thousands of dollars per year instead of hundreds of dollars a year. You don't want to surprise, because they don't, it's not something that they need your permission. The renewal happens automatically. It just goes through your bank account. So make sure every year you renew or review your insurance needs. You just ask your advisor to do an insurance needs analysis, figure out which ones you need, which ones you don't, and make decisions accordingly. Let's talk about investment management. What we're talking about is reviewing your investment accounts. Obviously, the first thing you want to review is what's your risk tolerance like. If you're moving into retirement and you're not the same person you were pre-retirement, versus post-retirement. When you go into retirement, so many retirees tell me they're afraid to spend money, they're afraid to invest their money aggressively until they fully get into retirement and they see what it's like and how much money they need, and they realize everything's fine because they got a financial plan, right? But you want to review your risk tolerance, make sure that you're not overly exposed to equities. You need equities, but you may not need 70% of your portfolio in equities anymore. So make sure you go through a risk analysis to make sure you're not overexposed to equities. But the next thing you want to know is do something that depends if you're in a position where you have this happening, but I like this word, tax loss harvesting. You'll see it commonly said tax loss selling. This is really about a very simple strategy. You're selling investments in non-registered accounts that have losses in them to offset any capital gains realized elsewhere in your portfolio. You can carry those capital losses 3 years back or indefinitely forward. So there's something you want to do in November and December. There's a deadline as to when you got to have this done. You can't initiate this on December 31st hoping that you're going to be able to do this. You got to do this, I don't want to say before the end of the year. The 27th is usually the last day that you could do this because you need a couple of days for everything to settle, but I wouldn't wait to the very last minute. I'd get it done, maybe a week before that. But this is a very important thing for you to do to make sure that you're carrying some of those losses. You can offset your future capital gains as well. Let's now talk about RSP contributions. Now you're saying, why would I be reviewing RSP contributions? Because in 2 months, you're going to be thinking about that anyway. Every year in February, everybody's thinking about how much money do I put in my RSP, and whether it's you're thinking about what's the maximum you're going to get on the refund, or you're thinking about what's the maximum I should be putting in because that's what it says in your financial plan. Keep hitting you over the head with getting that financial plan. But what you're really talking about is maximizing your deferred growth. Yeah, it's true. You have until February 29th, that's the last day for the deadline this coming year in 2024, to make your contributions for the 2023 tax year. But if you get it in sooner, you're maximizing the deferred growth. So that's the whole message here. Is the beginning I led with, make sure you're fully funding your retirement accounts. So here's the opportunity, make sure you've put in the appropriate amount of money for each year. Now your limit is 18% of your earned income for the previous year, unless any pension adjustments, any previous unused RSP contribution room, and any pension adjustment reversals. There's the big lingo about what's the limit for you. RRSP contributions. Now this really doesn't apply to many of my clients. Their kids are all over the university age, or they have a couple that are just finishing up. So their contributions are all done. What this really is attention to grandparents and parents. You might be in a position where you can fund your grandchildren's RESPs. A lot of people, when I'm doing financial plans, we talk about what are the opportunities for you when you're in your golden years or your senior years. And many people are flush with capital because you've done these downsizing events. You may have liquidated some real estate positions, whether they're rental properties or that condo in Florida that you're not going to anymore. So you say, well, what could I do with this? Well, you could help your grandchildren out by funding their educations. That maybe it's harder for your children to fund your grandchildren's accounts because things have become so expensive. So here's a great opportunity for you to do that. The Education Savings Grant is 20% on the first $2,500 in an education savings plan, so $500 annually per child. It's a great opportunity for you to fund those accounts, but you got to get those in before the end of the year, because then you don't get the tax credit, right? So that's the whole thing, or not the tax credit, but the grant. So you want to make sure you do that. Moving right along, and we are now into the last four slides. We're done. This is the last category. Let's talk about personal finance, and this is again reviewing your accounts. This whole section is about tax credits. There's some very interesting tax credits coming through COVID. A lot of people, bought homes that had offices. People ended up living together. Lots of things changed. So there's actually some credits here you may not be aware of. So let's look at not leaving any money behind. So the first one that we want to look at here is the home accessibility tax credit. This is for people, seniors who are receiving the disability tax credit. This is to help you with certain home renovations. it's equal to 15% of the expenses towards renovations. That's going to make it more mobile, more functional, prevent injuries or injuring yourself, getting in and out of the home. That's what it's used for. You can spend $20,000 and this credit could be worth up to $3,000, but you got to have that paid for. So you got to write the check to those people before the end of the year for you to be able to file. Obviously, you can't file the tax credit for money you haven't paid, right? So you got to get that done. This one I really love, and I've seen more and more of this. This is a multi-generational home renovation tax credit, and this can help you for creating that in-law suite in your home. So this is a refundable tax credit worth 15% of the value of your qualifying expenditures. $50,000 you can spend or more on this. So if you were to spend $50,000 putting in that in-law suite, you're going to get $7,500 back of this tax credit. So this is really a valuable resource for you, especially with seniors. You know, I saw a lot over the last 2 years of where families said, we don't want our parents in these retirement homes that had a lot of COVID issues going on. Let's get them out of there. Let's protect them. We'll put them in our own homes. We'll be able to watch for them, watch over them, and we'll just create these in-law suites. Well, here you go. Here's a tax credit that'll be very useful for you. Well, I hope today's video you got a lot out of. I enjoyed this video as well. I always like doing these videos. I love hearing your comments and reading your comments, and obviously don't hear them, but I read them and I try to reply to everybody. It is me replying, it's not somebody else. So please continue to make those comments. Share this video with anybody you think that needs to see this checklist. Again, I always like to end my video by saying we take care of your wealth management so you can take care of what's most important to you. Again, thanks for spending time with me tonight, and I look forward to seeing you in the next video. Take care.